The market is currently open on this Thursday, June 11th, 2026, and Plug Power is trading live at $2.86 per share, representing a downswing of 1.72% in intraday trading on significant volume. If you look closely at what is happening under the surface right now, this drop is not just a random zigzag on a chart. It is part of a harsh reversal from a peak of $4.33 just over a week ago, wiping away roughly $1 billion in market value in a matter of days. But here is the piece of information that the broader public is missing while they panic sell on their retail apps. Institutional traders are quietly treating this pullback as the handle section of a massive classic cup and handle technical chart structure. While casual retail investors panic because the price is dropping, sophisticated desks are tracking the 100-day exponential moving average, which is holding steady beneath this price action, showing that the midterm structural floor for the asset has radically shifted over the past 2 months. The common consensus around Plug Power has always been that it is an expensive science project, a perpetual cash-burning engine that survives solely by diluting its equity holders. The reality, however, is that the first half of this year has delivered the most aggressive internal structural repair the business has seen in its entire history. People love to look at the massive headlines surrounding high-flying tech names like Tesla stock, Apple stock, or Nvidia stock, and they assume clean energy infrastructure is dead because the interest rate environment has remained restrictive. But the reality is completely upside down. While everyone was watching big tech, Plug Power just reported a massive 42-point year-over-year improvement in its gross margin, pulling it from a disastrous negative 55% all the way up to negative 13%. This means the bleeding is rapidly slowing down, and the enterprise is systematically proving it can adjust its internal pricing structures to match the high cost of grid dependence. When you track daily swings using premium Interactive Brokers trading accounts, or look at order routing data on a professional Interactive Brokers platform, you notice a massive divergence in institutional activity. The retail community using simpler online investing sites often bails out at the first sign of a multi-day drop, but the big block orders tell a story of accumulation near the $2.80 support zone. The massive volume spike we saw earlier this month when the stock neared $4.30 was not just speculation. It was the market realizing that the firm is finally executing on its asset monetization plan. They just pulled in nearly $40 million by selling a federal investment tax credit for their St. Gabriel hydrogen facility in Louisiana. They did the exact same thing with their Georgia facility last year. This tells us the company is finding creative, non-dilutive ways to patch its balance sheet, rather than simply dumping hundreds of millions of new shares onto the open market, which had been their classic playbook for nearly a decade. For anyone managing their own individual brokerage account, or using automated tools like Schwab Intelligent Portfolios to balance out an aggressive clean energy allocation, navigating a hyper-volatile stock like this requires an intense look at macroeconomic pressures. We are dealing with an asset that behaves completely differently from a stable consumer staple. When a self-investing user logs into a Robinhood stock trading setup or opens the Robinhood app to look at hot clean energy assets, they often get blinded by the massive percentage swings. But if you talk to an advisor providing high-level investment help, they will tell you that the true value of Plug Power right now lies in its shifting unit economics. The cost of third-party hydrogen sourcing has historically killed this company because they promised their material handling clients a fixed price for fuel, while they themselves had to buy that fuel from volatile spot markets. Now that their own domestic production plants in Georgia, Tennessee, and Louisiana are scaling up to 40 tons per day, they are keeping those margins in journal. Let us step back and look at the broader landscape of online investment choices. Many investors who rely on a traditional Fidelity brokerage or construct a conservative portfolio out of core Fidelity ETFs and foundational Fidelity mutual funds tend to avoid micro or small cap clean energy names altogether due to the absolute lack of predictability. If you manage your money through high-tier Fidelity Wealth Management or shelter assets in long-term vehicles like Fidelity IRAs, a stock trading below $3 usually looks like an unnecessary gamble. Yet, if you look at the sophisticated charting tools on the Fidelity trading platform or track the order book through the Fidelity mobile app, you can see that the entire industrial green sector is experiencing a subtle rotation. Large institutional asset managers are beginning to realize that the transition to green logistics is no longer a political debate. It is a corporate mandate for major global enterprises. Consider the clients that actually use these products. Companies like Walmart, Amazon, and Home Depot cannot run their massive fulfillment distribution centers on traditional lead-acid batteries if they want to maximize multi-shift warehouse throughput. They rely on hydrogen fuel cells because they can be refilled in 2 minutes, compared to the hours it takes to swap and charge massive industrial batteries. This fundamental corporate utility is the ultimate floor under the business model. When people look at the SoFi trading platform or buy fractional positions through SoFi Active Investing, they are usually betting on consumer trends, but Plug Power is entirely an enterprise infrastructure play.
The real question for anyone engaging in online investing through SoFi investing apps or scanning SoFi stocks is whether the operational runway will last long enough for the macro environment to soften. The company has explicitly stated that they are targeting a positive EBITDA run rate by the final quarter of this year, with full operating profits slated for the following year. That is a massive statement for a business that lost over $1 billion in consecutive years recently. Comment below how many shares of Plug Power you currently hold, or let me know if you are completely avoiding the hydrogen space right now. Hearing how different people manage these high-risk plays across various platforms provides incredible insight into current market sentiment. To truly understand why the tension between market expectation and underlying reality is so dramatic here, we have to look closely at what this business actually does. At its core, the company does not just manufacture fuel cells. They are trying to build an entire vertically integrated supply infrastructure from scratch. They build the electrolyzers that split water into hydrogen and oxygen, they operate the liquefaction plants, they transport the liquid fuel in specialized trailers, and they install the storage and dispensing systems at customer sites. This is incredibly capital intensive. In the past, the market gave them an unlimited credit card because money was practically free. When interest rates spiked, that model broke completely, causing the historic collapse from its all-time highs down to the dollar range. The old report showed a business that was completely out of control, with gross margins dropping to a shocking negative 91%, as supply chain snarls and high power prices slammed their early production facilities. But the new management framework has forced a pivot toward absolute capital discipline. The recent monetization of the St. Gabriel tax credit to a third-party investor proves that the current regulatory landscape, specifically the clean energy tax provisions, is providing a tangible life raft. By transferring these credits, they are bringing in non-dilutive cash to fund the scale-up of their high-tech systems globally. They currently have over 320 megawatts of electrolyzer capacity deployed on 5 continents, alongside an active project pipeline that spans major international industrial projects, including massive system deployments in Portugal and Spain with major energy giants. This international diversification is a crucial buffer against purely domestic policy changes in the United States. If you analyze this through a professional interactive broker's account or track sector momentum across the wider industrial space, you can see the potential scenarios shaping up for the rest of this year. In a best-case scenario, the company successfully closes its massive corporate asset monetization transactions over the summer, bringing in hundreds of millions in fresh liquidity without hurting existing shareholders. If their domestic plants continue to run efficiently and third-party sourcing costs keep dropping, that gross margin will continue its march toward positive territory. If they hit their target of positive EBITDA by the end of the year, the shorts, who have heavily targeted this stock across platforms like Robinhood and SoFi Invest, will be forced to cover, potentially triggering an explosive technical move upward out of that cup and handle pattern. Conversely, the risk case cannot be ignored by anyone practicing smart self-investing. If their internal production facilities experience unexpected operational shutdowns, or if their major enterprise customers delay the rollout of new hydrogen material handling fleets due to broader economic slowing, the cash burn could accelerate again. Even with the current buffer of unrestricted cash and incoming project proceeds, an unexpected delay in reaching profitability would force them back to the capital markets, triggering further dilution that would break the current technical support levels and send the asset back to its 52-week lows. When you look at how this entire narrative balances out, the contrast between expectation and reality becomes the defining factor for the stock. The market expectation, heavily priced into the recent multi-day slump, is that the company will inevitably stumble before reaching the finish line of profitability, failing to overcome its legacy of operational inefficiencies. The emerging reality, substantiated by consecutive quarters of massive margin improvements and disciplined asset monetization, suggests a leaner, structurally sound business that is successfully transitioning from an idealistic builder to an efficient industrial operator. Whether you use advanced platforms like interactive brokers, manage a long-term position inside a Fidelity brokerage, or track quick momentum swings on a casual Robinhood app, understanding this core tension is exactly how you separate short-term market noise from true long-term structural changes. Turn your attention away from the daily percentage noise and look closely at the unit economics over the next 2 quarters, because that is where the real battle for the future of this enterprise will be won or lost.